Did we just get closer to a recession? And what is the Federal Reserve's eerie warning we need to talk about? In this video, we are going to cover all of that. We're also going to touch on the fact that now Big Lots is going out of business. The corporate buyback blackout window has begun, which means no corporate buybacks to prop up lofty share prices. And some are accusing Jim Cramer of just ringing the bell at the top of the market with Donald Trump, causing the market to crash. Others say this has everything to do with the government shutdown that starts tonight at midnight, in line with the expiration of the Trumponomics coupon code sale expiration. Tesla's under 420, markets are red pre-market, and expected to be red during the day, but we'll see what happens. The Nasdaq lost 517.20 yesterday, which is a pretty important line, and Bitcoin sold down a chunk, though it did bounce a little bit after we got those PCE numbers this morning. Some were worried that the Japanese carry trade 2.0 is about to take place, maybe another banking crisis. People were freaking out about the yield curve, and the Philly Fed gives us some warnings. In this video, we're going to break down all of this and more, so let's just get right into it. First, one of the most scary things that some folks are bringing up, rightfully so, is the letter from the Federal Reserve, the FOMC statement from October 31st, no, not this year, but 2007. I highlighted it for you, and ignore the blue because that is different. That talks about the housing correction. But just listen for a moment to everything outside of the blue that's highlighted in yellow and red. And I want you to remember that this was 14 years ago, before the Great Recession. This is what it sounded like. The FOMC decided today to lower its target range for the federal funds rate by 25 basis points. Economic growth was solid in the third quarter, and strains in financial markets have eased somewhat on balance. Readings on core inflation have improved modestly this year, but recent increases in energy and commodity prices, among other factors, may put renewed upward pressure on inflation. The committee judges that after this action, the upside risks to inflation roughly balance the downside risks to growth, which is eerily similar to what we just heard from Jerome Powell, that the risks to the labor market and inflation are roughly balanced, that inflation has recently ticked up a little bit, again, causing a little bit of concern, though hopefully it just ends up being a technical issue or a rounding issue and that inflation truly isn't a problem. The eeriness of how similar that letter isn't great. It's leading a lot of people to reiterate that. Remember, when the Fed cut 50 basis points, they did so on the exact same day in September in 2024 as they did in September of 2007. And this is why a lot of people are now looking at the New York Federal Reserve, which posts an indication of the probability of a recession in the 12 months ahead. And they argue, wow, it dropped. The odds of recession actually plummeted from around 70% to around 33.5%. But wait a minute. This is the probability of a U.S. recession predicted 12 months ahead in November of 2025. And so what actually happened, if you look at 2007, is you also saw the odds at the end of 2007 and beginning of 2008 plummet that we would be in a recession in 12 months because the market started indicating, yeah, we're not going to be in a recession in 12 months because that would be, say, the middle of 2009. We'll already be through the recession that's happening, say, within the next 9 months. So this is making some folks nervous that actually a fall of this recession probability 12 months out could be an indicator that the reason the recession indicator is falling is because we're about to go through one. Now, that's not great. Nobody's excited about that, and a lot of people are referring to the pork barrel government funding bill that failed yesterday as potentially a reason why markets are uncertain. We're going to break that down and go through that, but first, Mary Daly did have some commentary this morning. So let's start with that. Let's hit what's going on with some of the PCE inflation numbers. We'll look at some technicals here, and we'll make sure we talk about that government funding bill as well, because I know a lot of people are concerned about what's going on there. I do want to mention that some folks have asked us, hey, would it be okay, now that the market is starting to correct a little bit, to extend that deadline at househack.com for the offering that we have? the bond yield, and it's a convertible, so you get all the upside in the stock and you get a 5% yield. Some people are like, hey man, look, if the market's going to turn here, I'd like to diversify into maybe the private market. And so if that's you, if you are interested in that, maybe we can pull that off. We'll see. Email us at IR, like investor relations, at househack.com. Okay, so with that, Mary Daly this morning says that policy is in a good place. She says that positive sentiment amongst firms is giving her enthusiasm. Now, I personally think that's crazy, that sentiment amongst firms after you had a presidential election of a Republican, which generally always leads to a boost in sentiment, would actually lead the Federal Reserve to say, oh, okay, well, everybody's so excited, maybe we should be a little tighter. I think that's kind of dumb because sentiment changes very, very rapidly. And I don't think that's really a way to lead the Federal Reserve, especially since, when the Federal Reserve was excited 2 days ago, we were at greedy levels in the stock market, and all of a sudden market momentum, we were almost at extreme greed levels in terms of market momentum, and all of a sudden when you look at the CNN Greed and Fear Index, oh wow, look, we're at extreme fear. See, sentiment changes at the drop of a hat. I don't know that our Federal Reserve should really be guiding their policy decisions on business sentiment, but then again, they've lost a lot of credibility during this last cycle, and it seems like they're just continuing to lose even more. Anyway, inventory building up is causing a reason to be cautious, says Mary Daly. This actually aligns with what the Philadelphia Fed warned a little bit. This report actually came out yesterday. Very, very few people talked about it, and I wanted to bring up some of the details from the Philly Fed. So this is what the Philly manufacturing indicator read. It indicated the lowest level of manufacturing since April of 2023. Okay, not going back too terribly far. The index for new orders and shipments both declined and turned negative. All right, that's not great. And the employment index edged down, but more than 70% of firms reported no change in employment levels in this month. Just 17% reported increases. That actually didn't sound too horrible if it stays that way, but it's worth noting this current activity bar doesn't look great just because we're getting back to the lows that we saw at early 2023, and I'm worried that potentially those could continue if we end up seeing this buildup in inventory. Remember, the whole point of what Mary Daly here is saying is that if inventory builds up, then manufacturing slows even more. When manufacturing slows even more because inventory builds up, that's when you truly start seeing more layoffs and unemployment gets hit. And when unemployment gets hit, that's when consumer spending plummets. So the order in which a recession takes hold generally starts with a buildup of inventory, then the layoffs, then the spending goes down, then the unemployment claims skyrocket, then the unemployment rate goes up, right? This is why some of those latter things are lagging indicators. But then again, there was some hope because this morning we did get PCE numbers, which came in a smidge lower than expected. Personally, I think we're not facing an issue of inflation in this cycle. We're facing an issue of deflation, but not everybody agrees with me on this. I think most of the categories that are left in terms of inflation, because I go through every single inflation report every single time in detail, the categories that are left of inflation are really super lagging. I think most companies have really lost their PP. And you don't want to lose your PP. When you're a business, you need pricing power, otherwise you're screwed. So I'm very disappointed in over the last year seeing how much pricing power has just absolutely been destroyed at companies. And so it has made me more nervous than typical. Anyway, PCE did come in a little bit lower than expected this morning. PCE and core PCE both coming in at 0.1% month over month versus the 0.2 expected. Year over year numbers did miss by 0.1% as well. Personal income missed by 0.1% and personal spending matched. This did help boost Bitcoin by about $1,500 right when that number came out. But from a trading point of view, I'm still a little bit nervous because take a look at this. Yesterday in my courses, I sent this post. You can see here, yesterday at 7:41 a.m. This is an example of the kind of trade alerts that I send, but actually this is more of a trend alert because I send trend alerts and trade alerts. Like if I actually execute a trade, then I'll be like, hey, look, I bought this option. Whereas this is a trend alert setting up for a trade. So I wrote this, QQQ at decision point. 517.20 was my warning this morning when the Qs were at $520. Bouncing here is critical. Otherwise, I worry we may or we could start a few days of a sell-off. Losing this line may put options desirable for the third week, may make, I guess I typoed that, but anyway, you get the idea. May make put options desirable for the third week of January. So basically buying put options a month out for some of the volatility that we're about to potentially experience. And what you'll find is if you actually line this up with the line that I have over here, that 517.20, when we lost the line here after, failing to break out twice on it with what looked like a double bottom, we really just continued to lose and lose and lose that level, which is not great. And this is leading some people to say, hey, Kevin, thanks for having a launch sale for the Trumponomics course, which comes with all of these stock alerts. So if you want those alerts where all of a sudden you get a little ping on your phone, oh, Kevin sees a trend or Kevin has a trade idea, make sure to join Trumponomics today. You can grab it by going to meetkevin.com. Comes with some critical tax strategies you can still implement this year and next year, obviously, under Trump, as well as insights into stock, growth sectors, real estate analysis, job and income strategies, negotiating strategies, sales strategies, everything related to Trump and making money in the economy, even if you don't like Trump. Now, with that, a lot of folks are also asking me, Kevin, what about the carry trade? Well, it's worth noting that the Japanese yen is sitting at about the same devalued level as it was around July 10th. Remember, the Japanese carry trade blew up over here because all of a sudden the Japanese yen had lost so much money that people had to cover their margin loans and their loans on U.S. stocks, basically, and that led to some panic selling. Now, that did end up leading the yen to fall afterwards. But if you notice, July 10th was our summer stock market peak. We were at 161 yen per dollar. If you look at where we are now, we're at 156. Pretty dang close to the same levels we were at that peak in the summer. Now, Tom Lee is saying, hey, man, just back up the truck and buy the dip. And maybe that's the right strategy. After all, AT&T is mandating a 5-day return to work, that is return to office in January, which kind of follows what Amazon is doing. A lot of people think this is just a quiet way of trying to fire people who can't go to the hubs that AT&T has. See, AT&T, for example, says all 18,000 of you must go to the hubs that we have in Dallas, Atlanta, LA, Seattle, St. Louis, Middleton, or Bedminster, New Jersey. Well, what happens if you don't live close to there? You'd have to potentially move. Well, moving and trying to get a new home or even a new rental in this sort of economic time or around the holidays might be a little tough. Anyway, bond yields are up roughly 100 basis points since the Federal Reserve cut 100 basis points. And this adds a lot of restrictiveness to the economy just as the corporate blackout window is happening. Big Lots is going out of business. And a lot of people are angry that Elon Musk should now be called President Musk because he has so much control over Donald Trump, almost like a puppet master. Others say, no, he was just trying to kill a wasteful bill. I broke down what was inside of the bill in another video, so I won't break that down again now. Just look on the Meet Kevin channel and you'll see exactly what's in there. In fact, the title of the video is Elon and Vivek just killed a wasteful congressional spending bill. You can see that. Type that in with Meet Kevin. With that said, the replacement, a shorter bill, substantially shorter bill, in fact, you could see a picture of it here, looks like it should be a whole lot easier to pass. After all, this 1,547-page bill was destined to pass, and this one was destined to fail. Oh, wait, that's the opposite of what it should be. Yeah, this smaller, shorter bill failed miserably. In fact, 38 Republicans voted against it, including people like Tom Massey, who keep posting on X about how great Elon Musk is and how all of his ideas are wonderful, yet he also contributed to voting against that shorter bill. That shorter bill did call for extending the debt ceiling by 2 years to sort of open the door to what Donald Trump could do with the budget, but it wasn't convincing enough to get 38 Republicans on board with it, and you only got 2 Democrats to vote for it. And since Republicans don't have control of all chambers yet until the beginning of next year, this is not only potentially a preview of the gridlock of what's to come, but it's also a sign that even if you have control of all houses, you might not convince all Republicans. The government shutdown deadline is tonight at midnight, and there are arguments being made right now by people like Bernie Sanders and AOC that Elon Musk is a billionaire who's trying to rob people of defense contract money or money for pediatric care research. And it is true, there was a Yes, Give Kids a Chance bill added in as a rider to the continuing resolution to keep the government funded. It's a smaller bill as part of a larger bill package. Now, a lot of people, including Tom Massey and Vivek and Musk, say, hey, why don't we just vote on these bills individually? Like, why do we keep doing these giant package deals? Why can't we just do them a little bit at a time, individually, to keep the government funded, separately from the debt ceiling, separately from funding the government's defense contracts to cancer research? Like, we can pass these separately. And there's a reason for that. See, it's worth noting that Congress has operated like this pretty much forever. Congress is a two-party system, and it rarely passes legislation compared to really other forms of government. So when you look at other governments, they pass a lot more legislation than we do. This makes each package, like one big package, really critical for negotiating riders onto them. It's kind of like this. Hey, man, I'm a Republican. I'll vote for your package if, you let me hook this little 7-page bill in here because the people donating to get me reelected wrote it for me. I don't really know what's in it. I just want to kind of slap it in. You mind if I do that? And so all of a sudden what happens is you basically take a must-pass bill. Let's call this pink newspaper here the must-pass bill. And you take a must-pass bill, like funding the government, and then somebody comes along and says, hey, man, I need the New York Post in here. And then somebody else, and then I'll vote for the whole thing. All right, cool, vote secured. Hey, man, what are you going to need to vote for this? Well, man, I'm going to need me a slice of the LA Times. Okay, what are you going to need? I don't know, man, I didn't read it, but I need all this. Okay, will you vote for it then? Yep. All right, who's ready to vote? It's kind of the way it works. And I'm not saying it's right, it's just one of the reasons this happens is because each individual bill could get vetoed by a president, and Congress doesn't really want to give a president that much power. Back in the day, like in 1996, Bill Clinton used the line item veto to kill pork barrel spending line by line. Like he'd literally go through and go, nope, nope. He did that like 82 times in budget bills. And then that got ruled unconstitutional in 1998. It gave the president too much power. So if each portion of a budget was separated or each little bill was separated, you'd probably die in committee, you'd probably get killed by filibusters, or you would just get individually vetoed by a president that's like, nah, we don't need funding for cancer research for kids. Not specifically saying that that particular one wouldn't make it, I'm just saying that's how it could work, and this is why a lot of people are saying, well, let the chaos begin of nothing getting done. Because even though you're going to get Doge bragging about how, hey, look how we simplified the new bill versus the old bill, the old bill had a chance, the new bill had basically no chance. It was dead on arrival. And so some people are saying that Musk and Vivek are going to be great at keeping the government shut down. Other people say, hey, let it get shut down. The government is so dysfunctional, they need to have a cleansing. And if that means you need to chaos theory it, destroy some of it to get it all working again, then so be it. Let me know what side you're on in the comments down below. At this point, it's also worth noting that the yield curve between the 10 and 2 is steepening. And this is usually how you get onto your path to a recession. Generally, when the yield curve spikes, you have red markets. And so far, we've spiked from about 4 basis points uninverted to about 24 basis points uninverted. Now, that's somewhat arrested today as yields are catching up a bit today. But usually when this spikes again to about 50 to 90, you start the recession. That's just historically what has happened. Now, what else do we want to pay attention to? Well, there are indeed warning signs in the labor market that unfortunately a lot of people just don't want to pay attention to. Jerome Powell did give us a heads up of some of these, and so it's worth just taking a peek at kind of what these look like. Here you go. The job finding rate has collapsed over the last 2 months. You can see the collapse in the job finding rate over here on the right. It's not ideal, and it looks eerily similar to what we saw in 2001 during COVID and in 2007, 2008. In addition, the employment to population rate is falling, which is usually a characteristic only seen during recessions, though you did have a little bit of a nudge over here in 1995, which was associated with a soft landing, giving bulls some hope. Let's see here. What else? We talked about the New York recession odds. We talked about some of the data yesterday. Remember, this talk about continuing claims and initial claims, these are not incredibly useful. And then the leading index, I think, is kind of funny because the leading economic index came in and it beat expectations yesterday, but it actually includes stock prices, and stock prices have been pretty euphoric moving into that. So I'm not entirely sure that the leading index, which uses the stock market, could be much of a leading index for a potential stock market correction. Now, with all of that said, you know me at this point. I'm pretty low on the bull-bear scale. I'm somewhere around a 2.2 on the bear-bull scale, I should call it, which means I'm pretty bearish. What does that mean? I'm a big fan of paying off margin, take profits. I'd rather see you pay 30% in profits than to get the scars that I've gotten in my career. I have tried to avoid paying 30% in capital gains taxes, 20 plus 10% California. Maybe it's only 20 for you because you're not in California. But anyway, I've tried avoiding those taxes by diamond handing, only to go on to lose 70% instead of 30% to taxes. So consider that. I also think that diversifying is a really good idea. If you want more insights from me, obviously you can always join us in the Trumponomics course. Just go to meetkevin.com, and that way I can send you my alerts as well. There is a sale ending tonight when the government's supposed to shut down at 11:59 p.m. I'm calling it the launch sale because we just launched the lectures, so you could be a part of it right away. But as far as you and protecting yourself, I always like to say, get out of margin, get out of bad debt, make sure you secure your income, because whether or not we go through a recession, it is a logical idea to diversify and to minimize debt. I personally think one of the great ways you could do that, and email us if you want, because right now this expired, but we might reopen it. If we get a bunch of people emailing us saying, look, Kevin, if you're going to pay me 5%, and I get all the upside in house hack stock, until conversion, why would I not do this? Consider checking this out. Go to househack.com. You could learn about it. You could learn about my private real estate business, the multifamilies, the single families, the perks that we have for investing, before and after photos of properties, whatever. You're welcome to see all of that over at househack.com. Also, the deadline to send your money for RoboHack. You really had to fund by yesterday to participate. If you have some issue and your money's on the way today, just email us at invest@robohack.ai. Thank you so very much for being here. I wish you all the best and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.